Hi guys, with resident doctors agreeing to the government's offer to resolve the strike action, back pay and pay uplifts have been coming through in resident doctors' November payslips. And while it's great to get extra income, there may be, perhaps severe, tax consequences of receiving this back pay. So today we're going to consider how the back pay may change your tax position and the potential drawbacks to back pay. If you're watching this on YouTube, please consider liking and subscribing, and let us know in the comments if you've come across any other unexpected tax consequences that we don't mention today. And if you're listening to this on whichever podcast channel you listen to, please consider leaving us a review. It really helps us out. So what's been going on? Well, the government's offer increases pay for the years 2023 to 2024 and 2024 to 2025, resulting in a 22.3% average pay uplift over the 2 years, according to the BMA. As the pay increase starts from April 2023, that is, the offer is backdated, resident doctors working since then will receive back pay, and this is being included in November payslips. If you've changed employers since April 2023, you will then receive back pay from each of your employers for the period in which you were working for them. And, depending on the number of employers you had between April 2023 and November 2024, you may therefore receive several payments and several payslips. On those payslips, you will see the phrase basic pay Rs, Rs standing for arrears, and potentially you may see night duty Rs and weekend Rs, as in arrears, depending on the role that you do. So let's think about some practicalities first before we go into the tax. For your previous employers, do you have access to the ESR for that employer? If so, would recommend downloading your payslip and keeping it somewhere safe. If not, hopefully you'll receive a payslip via post or email, but if you receive nothing, then we'd recommend contacting your old payroll department to try and get that payslip so you have it for your records. Now, I've got friends who've told me that they've been struggling to get some of their payslips, so it seems this may not be particularly easy if you don't have access to ESR, but definitely worth trying because it would be really helpful to have that payslip for your records and also to check if it's right. Secondly, it's up to your employer or employees to action the back pay payments, but note that if you've changed employer and since you worked for them you've changed your bank account details, you should let them know to ensure that you get the pay that you're entitled to. Okay, let's now talk about some income tax consequences of getting back pay. Again, we're not dismissing the fact that getting extra income is very nice, but there may be some unintended consequences when it comes to tax, and it's important to be aware of these. So firstly, will you fall into the 60% tax trap? Basically, will this back pay push your adjusted net income for the tax year above £100,000? We talk about adjusted net income a lot of Medic's Money. We've done various blogs, etc. on this, but adjusted net income is basically your taxable income with some adjustments made to it. Your taxable income should be all sources of income, including your salary, less your NHS pension, any trading profits you may have, any bank interest, dividends, rental profits, etc. Then you remove some tax reliefs, such as employment expenses and any trading losses, if applicable. Don't forget to ignore sources of income that are not taxable, such as income from ISAs. The adjustments you then make to your taxable income are mainly deductions for gift aid, charitable donations, and private pensions. If your adjusted net income goes above £100,000, you will start to lose your tax-free personal allowance by £1 for every £2 you go above £100,000. And by £125,140, your entire personal allowance will be removed. In that threshold between £100,000 and £125,140, note that your marginal tax rate will be 60%, because not only will you pay income tax at 40%, you're also losing that personal allowance, and that pushes your marginal tax rate up to 60%. If you're on our financial wellbeing course, don't forget to use our adjusted net income calculator to work out your adjusted net income, and of course follow our tips for reducing your adjusted net income if they're applicable to you where possible. Here is an example of someone who has their income figures already entered into the spreadsheet. So you can see here someone with a pensionable income of just over £60,000 and non-pensionable income of £35,581,000. They've got some employment expenses. They've made no charitable donations in the year, and they've ended up with an adjusted net income of £86,827. Let's say that they get a back pay that includes basic pay arrears of £12,000, and let's enter that in to the calculator. And then let's assume that they get a non-pensionable income back pay of £4,000. So let's just enter that in. You can see that their adjusted net income now exceeds £100,000. It's now £101,327. So the doctor in that example will now have a 60% marginal tax rate on any extra income that they earn. So at this level, you may wish to bring that adjusted net income down and reduce your marginal tax rate. Now, the second income tax consequence is linked to the first one. Will the back pay impact your tax-free childcare? So if your adjusted net income goes over £100,000, even by just £1, you lose access to the tax-free childcare scheme, which is worth £2,000 a year per child towards childcare costs, and also the 15 or 30 free childcare hours as well, which can be pretty costly. In the example I gave from our spreadsheet, you can see that person would definitely want to reduce their adjusted net income if they can to retain their tax-free childcare benefits. So just think, what is the back pay doing to your adjusted net income? Are you now in the 60% marginal tax rate? Will you now lose your tax-free childcare? So just watch out for that. Okay, thirdly, has your tax code changed? Now, we talk about tax codes quite a lot on Medic's Money. We've got lots of blogs on these on our website. Tax codes are codes, hence the name, that usually come as a combination of a number and then a letter or letters. The code is sent by HMRC to the relevant payroll department, and it's important to know that your payroll department cannot change your tax code. Only HMRC can change your tax code. Now, it's not uncommon for doctors to be put on the wrong tax code by HMRC, so it's always important to check your tax code anyway, but would recommend you check your tax code on each of the payslips you receive. You may see one of the so-called emergency tax codes, which may or may not be incorrect. Okay, just because you're getting one of these codes doesn't necessarily mean that it's wrong. So some common emergency tax codes include D0, where HMRC do not give you any personal allowance and assume that all your income should be taxed at 40%. Less likely, you may see D1, where they assume all your income should be taxed at 45%. If you get a lump sum back pay amount from a former employer with a D0 tax code and you are a 40% taxpayer, then this is likely to actually be correct. You pay tax at 40% and D0 takes 40% off the back pay as income tax. So, you may be fine in this situation. The next emergency tax code is BR, where HMRC do not give you any personal allowance and tax everything at 20%. Now, that may again be correct, but unless you're a basic rate taxpayer, this is unlikely to be correct. So you might actually owe tax if you're actually a 40% taxpayer. Another emergency tax code is 0T, where HMRC take away your personal allowance, but then work out the tax by looking at the income and going through all the income tax rates of 20%, 40%, 45% in turn using the income tax thresholds. So basically they just pretend you don't get a personal allowance, but apply the tax rates as they would do otherwise. If that's on your current employer payslip, that may be incorrect if you are owed a personal allowance. That is, your adjusted net income does not exceed £125,140. Even if you're not due your personal allowance, often doctors get tax relief on their allowable employment expenses through their tax code. So check that you're still getting tax relief for those employment expenses. Also, if you're a 40% taxpayer and you get a lump sum from an old employer with a 0T tax code, are you actually underpaying tax on that lump sum if a large part or all of it is being taxed at 20%? So a few things really to think about when it comes to a 0T tax code. So definitely think about those. You may potentially see your tax code change from something called CUMU at the end. So you got your number and your letter. You may see something called CUMU, C-U-M-U, which stands for cumulative. That may change to non-cum, which stands for non-cumulative. Just to say that sometimes instead of seeing non-cum, you may see an M at the end of your tax code instead. Those are usually mean the same thing. A change to a non-cum tax code does not necessarily mean an issue. It means that HMRC are calculating your income tax for the month with no reference to tax paid previously. And essentially, they're taking 1/12 of your personal allowance, 1/12 of your basic rate band, etc., and then working out your tax. A cumulative tax code, that works out your tax taking into account what you've already paid in the tax year so far. It's mainly useful for people who did not work the whole of the tax year. So a change from CUMU to non-cum doesn't necessarily mean that things are bad, okay? And then finally, even if your tax code on your main slip is currently okay based on your November payslip, please make sure you check this is still the case on your December payslip, as HMRC may well get confused by the multiple payslips you received in November and think you now have more than one job going forward, and then they'll change your tax code for your main employer in your December payslip. It's a little bit like the issue that a lot of doctors get in September after switching trusts in August and then getting two payslips for August. That often confuses HMRC, and they change the September tax code to a wrong emergency tax code. I'm sure there'll be many people listening to this who've had that happen to them. Okay, aside from income tax, there may also be pension tax consequences. Now, firstly, have you moved into a new pension contribution tier? So up to 40 hours of basic pay is pensionable. So you may find that some or all of the basic pay, back pay, is pensionable. Any weekend or night shift arrears should not be pensionable. So you may find, as I say, you're getting a basic pay arrears, they come into your pay slip. It's very likely that NHS pension will apply to those new, that lump sum. But moreover, note that your pensionable earnings may cross into a new contribution tier. If it does, then all your pensionable earnings will be subject to this new contribution rate. The current rates go from 5.2% at the lowest for pensionable earnings up to 13,246, all the way up to 12.5% for pensionable earnings over £53,973. So let's take an example. If your pensionable earnings were £58,000, you would have a contribution rate of 10.7%, which results in pension contributions of £6,206. If you then get basic pay arrears of £5,000 and your pensionable earnings are now £63,000, then that extra £5,000 will tip you into the new contribution tier, and your pension contribution payments will now be £7,875 because the 12.5% is applied to all of that £63,000. Secondly, are you now going to get an annual allowance charge? For some, the back pay may create an issue regarding the annual allowance, creating an annual allowance charge. Now, annual allowance tax charges are levied when the calculation of your pension growth exceeds £60,000 per annum. Whilst this is a high allowance, large uplifts in pay can create large growth calculations. That said, you can use up any unused allowance from previous years, so most resident doctors will hopefully not be caught by this. And on that note, we're going to leave it here. And to reiterate, not everyone will have issues with the receipt of their back pay, and many won't have any issues at all. And as we said, it's always nice to get extra income. But some people will be affected by one or more of the above issues. And as always, it's important to be aware of your finances and how you are affected. All right, guys, I really hope you found that useful. Thanks for watching or listening, and have a great rest of your day. Cheers.